What is going on, investors? My name's Emmanuel, and investors, I just wanted to record this video for us to have a heart to heart. Let's get real. Let's be real, okay? Because I'm starting to see it within my Discord, and I think I'm also starting to see it within the YouTube community that people are starting to really hurt, okay? People are hurting, investors are hurting. It sucks seeing your portfolio in the red, especially if you started investing, last year, March, or anywhere between last year, March, and probably early February this year. All you've really experienced, let's be honest, is the market going up. But here's a quote that Peter Lynch said. He said, "A decline in stocks is not a surprising event, it's a recurring event." And I would highly recommend this book, Beating the Streets by Peter Lynch. The link is in the description below. Get this book. You need to understand the type of game that you're playing, because this kind of game is not for the faint-hearted. Okay, it's not a get rich quick, even though it's felt that way. It may have felt like a get rich quick, especially over the last couple of months. But the reality is we do go through declines. I want to share with my YouTube community what I shared with my Discord this morning. Okay, so in the morning briefing, I said to my Discord members that I've had numerous conversations with a few elite members now, and the common question seems to be, how long will this correction or this pullback last, or how long will my portfolio remain in the red? And it's a valid question, and I'm sure many of you in my YouTube community are asking yourselves the same question. You're probably at the verge of giving up, but now is not the time to give up in the slightest. The cheaper stocks get, the lower the risk, and the higher stocks get, the higher the risk. And that's what's happening right now. Stocks are becoming less and less risky the cheaper they become. If I liked a company at $20 and the share price has dropped to $10 through no fault of the business, the fundamentals haven't changed, the earnings are still getting better and better each quarter, but yet the share price is down, maybe because Jerome Powell was having a bad day, or Yellen was having a bad day, or whatever, or another third wave in Europe. Whatever the reason is, your stock just got cheaper. And if you loved it at 20, it's even more attractive at 10. And this is the way you need to start thinking and start conditioning and start training your mind to perceive these stocks when they go down. I gave an illustration, okay? The table below shows every S&P 500 correction, crash, and bear market during the 50-year period from 1970 to 2020. Now let me show you the table. This is over a 50-year period. And if you take a look, the S&P 500 from 1968 to 1970, so for 2 years, there was a decline of up to 36%. And before we dive deeper, just to explain what the colors represent, the greens represent a correction or a bear market of less than 100 days. Then the yellow represents a bear market or correction that lasted longer than 100 days. And the red represents a decline that lasted longer than 200 days, okay? So if you look at it, pretty much almost every decade, we saw a decline. In 1968 to 1970, so over a 2-year span, the market was down for 543 days. And the total decline over that period was a 36% decline. And look, even in 1971, so the following year, there was 2 corrections. There was 2 bear markets in that year alone. And 1973, literally 2 years after the mini corrections that we had, the investors at the time had to go through another even deeper crash than the one in 1968 to 1970 of 48%, and that lasted for 630 days. So think about it. A year, there's 365 days in a year. This lasted for 630 days. That's insane. And then once the market recovered again in 1974, there was another correction of 13%. And then the following year, can you imagine being an investor during the 70s? Rough time. All the way to 1979. It's correction after correction after correction after crash. And I'm not saying that we're going to go through that, but I just want you to understand the type of game you chose to play. And this is over a 10-year span. So if you're not prepared for this, then this really isn't the game for you. And moving on to the 80s, you can see there was a lot less corrections and crashes in the 80s than there were in the 70s. 70s was terrible, but the 80s looks like a very good decade to actually be investing. But think about the amount of investors that gave up between 1968 and 1979. You know, many investors would have given up at this point. But those who didn't give up and continued averaging down went on to experience a great recovery, because between 1980 to 1982, you had a 27% decline that lasted 622 days. Then 83 to 84, 14% decline. And 87, you had a 33% decline, which lasted only 101 days. But look at the 90s. The 90s, again, you went through more corrections than you did in the 80s. So the 80s was a very good era to be investing. And all through the 90s, we had mini corrections here and there, 10%, 19%. But if you look at it, look at the contrast. They didn't last long. The longest in the 90s only lasted for 91 days. And then you had the year 2000, so that's the dot-com bubble. And that lasted for 929 days. A total decline of up to 49%. Insane. And then the following year, 2002 to 2003, you had a 14% decline of up to 104 days, and then nothing. It's pretty much a bull market up until 2007, 2008, that crash, which was probably the worst crash. Let's have a look. Yeah, it is the worst crash. In 2007 to 2009, between 2007 to 2009, had a decline of 56% that lasted for 517 days. And you know what? Let's take a look at the chart for that period, actually. So we're on the SPY, so it's the S&P 500. So from 2007. So the reality is none of us know when a correction is about to happen or when a crash is about to happen. So you're investing here, okay? In October 2007, you can see the market has had a nice, beautiful run up from 2000, well, pretty much throughout the whole of the year 2000s. It's been a beautiful bull market up until October 2007. And we all know that's when the crash happened. And look at that. It declined all the way to March 2009 by a total of 57%. 57%. Sorry, let me bring it back up for you. So can you imagine investing during that period? So for almost 2 years, the market went nowhere but down. How are you going to survive in a market like this? And the only way to survive during a decline like this, seeing your stocks go down for over a year, is to just continue to dollar cost average. That's the only way. That's what Peter Lynch says, know what you own and why you own it. If there's nothing wrong with the business, if the fundamentals of the companies that I've invested in haven't changed, then, but the share price continues to decline due to global economic events, the only option is to continue to dollar cost average. Because if you kept on buying lower and lower and lower, then you've set yourself up beautifully to enjoy the recovery. And if we're going from the lows all the way to, let's say, 2013, 164% return, about 160% return, you would have enjoyed all of those gains. But let's assume you didn't dollar cost average, and you gave up around this period here. Okay, the market's declined from there. You've seen the market go down, 20%, too much pain, and you give up and you sell out, or maybe you hold on a bit longer and the market continues to decline another 20%, 30%, and you give up there. Or you hold on a little bit longer and it declines even further. The only way you're going to continue investing during these declines is if you know what you own and why you own it. Okay. So at any point of these declines, you could have given up, or you could have run out of liquidity and cut your losses and then exit the game. But then you would have missed out on the recovery. And the market, history tells us, always recovers. But let's just say you didn't even have any money to invest again. And let's say you stopped investing around this period, then eventually the market will recover and continue higher. Yes, you would have to have waited 4 years. You've had to have waited from 2008 to 2012. well, 2011, yeah, let's call it 2011 to actually break even, which is a very long wait. I would rather just continue buying lower and lower. But the fact is, the market continued higher for the rest of the years to come, and people who continued dollar cost averaging during that period made a killing. They are the ones that experienced generational wealth. And now, if we fast forward to where we are now, I mean, look at it, guys. If you're feeling pain already, look at where we are right now. Okay, look at where we are, off its highs to where we are now. The S&P 500 is only down 2%. It's only down 2%. And it's been down for maybe 2-3 weeks. So if you're feeling pain now, what's going to happen if it declines to where we were, let's say 30%? This was March, right? Yeah, let's go to March, see where we are. 34%. It was painful during that period. And I was investing during this period. So if we're being real, 2%, we haven't really experienced anything. I know it's painful, but the reality is we haven't experienced anything yet. And I just wanted to shoot this video just to be real, just to give you some encouragement and let you know that this is normal. Okay, I'll bring this quote back up, and if there's nothing that you gain from this video but maybe this quote, then this video was worth it. Okay, so a decline in stocks is not a surprising event, it's a reoccurring event. All right, so yeah, that's it. That's all I really wanted to say. Hang in there, you are not alone, but also recognize that these dips are fantastic buying opportunities. All right, so that's all I wanted to say. And yeah, I'll catch you in the next video. Take care. Peace.